Can you believe it's tax time already? 2020 was a crazy year, as we all know, but how is that going to affect your overall taxes? We had the CARES Act. Are you familiar with the Secure Act? Stick around and figure out not to make the mistakes that most people do each and every year when they file their taxes. Welcome, everyone. Show's called Your Money or Wealth. Joe Anderson here, president of Peer Financial Advisors. And of course, the show would not be a show without the big man, Big Al Clopine. He's sitting right over there.
Hey, Joe, how you doing today?
Tax filing.
Tax time, love it, right?
Is that your new thing?
That's my new signature.
Is that the new thing? Big Al with the Shooter McGavin here.
I got double.
Got it. You know, when you take a look at taxes, especially when people are filing, a lot of changes have happened over the last couple of years, and we don't want you to make the same mistakes that most people have, but you also want to make sure that you are aware of what is different this year. That's today's Financial Focus. Don't pay more tax than you absolutely need to, right? Pay your fair share, but you can do things to reduce your tax liability. That's us, that's the United States, that's our given right. $747 billion that we were able to take advantage of deductions. I would imagine that there's another several $100 million of missed opportunities. It's a huge issue, so let's put money into your pocket instead of Uncle Sam's. And who's better to help us out than Big Al Clopine?
So it is tax time, and Joe, I live for this time. So
you hate this time, Alan. This is why you got out of tax preparation. So
not anymore. I love it now because I'm not preparing taxes anymore.
But
let's talk about how to do better with your filing. So right off the bat, let's talk about not filing late. Make sure you file on time. Don't miss the deadlines, okay? Because the penalties are pretty big. We'll go over that in a second. We're going to talk about changes for 2020. We're going to talk about common mistakes, common tax filing mistakes, and then we'll want to get into some final tax filing tips. There's just a few more things that you can do between now and your tax return due date. So Joe, this is it's tax season. People need to start thinking about taxes. February 12th was the day the IRS started accepting returns, so it's time for people to get serious.
Yeah, some people are already tight at like January 3rd.
Some. I don't know too many like.
Yes, I'm more of an
How are you coming?
I'm an October kind of guy. I'm
yeah.
an October kind of guy.
Got it.
Right, but you know, speaking of the deadlines, right? I think everyone knows tax day is April 15th. You know, Alan, your birthday is right around there, so that's why you became an accountant.
Well, it's April 17th. I was destined to become an accountant.
Destined. And then partnerships and S corps is a little bit different. It's March. So March 15th for those, and then the C corporation, of course, is April 15th. That's the standard filing tax date, but there's also extensions that we all can use. Now, there's misconceptions, I think, too. If I extend my return, Al, then I might be more subject to audit. Have you ever heard that before?
Yes, we have, and we've heard the opposite, too, which is if you extend, they get to their quota of audits and they won't get to you. The IRS says it's baloney. Don't trust that. But you can extend, and it's a 6-month extension. It's now automatic. So for individual and C corporation, you can extend till October 15th. For S corporation partnership, it would be September 15th. And so realize when you do an extension, you extend the time to file the return, but you still have to pay the taxes due by the due date.
Well, there's penalties, right? I think people get confused. Is that, you know, I have this big tax bill, so I'm not going to file. I'm just going to pretend that, right? I'm just going to sneak into the abyss until I have enough cash, right, to pay the tax bill. But you absolutely don't want to do that. You still want to file, even though, let's say, if you have a larger tax bill that you don't have the cash to pay the tax, you still absolutely want to file.
Well, that's true, Joe, because there's a late filing penalty. So for an individual and a C corporation, it's 5% of the outstanding balance per month. So it maxes out at 25%. Now for an S corporation or partnership LLC, it's about $205 per partner. So if you file a couple months late and you have 10 partners, it's about a $4,000 penalty. There's no reason to pay these penalties. So make sure you file timely, even if you don't have the cash to pay it.
If I don't have the cash to pay it, I still file. What's my penalty for not paying?
Well, there is that penalty too. There's late payment penalty, which is another 0.5% per month, and there's the interest rate, which is 3% per month. So, Joe, it works out to about 9% per year for not paying in time.
So either way, the IRS is going to get their.
There's all kinds of penalties.
So file your return. Make sure that you have enough cash to to pay the taxes. Another thing too is, let's say people are waiting for refunds versus owing at the end of the year, and if they get refunds, they're like, "This is great," right? Or if they don't owe anything, they're like, "I didn't pay any tax." Well, no, it's coming out of your paycheck.
Yeah, that's right. You already paid, whether you know it or not. So, Joe, let's talk about what changed in 2020. So right off the bat, the CARES Act, that was signed in March. And the first thing that most people realized is there's a stimulus check for many of us. So the first one was $1,200 per individual, $2,400 per couple, $500 per child. There were phase-outs based upon your income level, so not everyone got it. That was based upon 2018 or 2019 adjusted gross income, whichever one was filed. But Joe, interestingly enough, it was actually a credit on your 2020 return.
Right, so people can still receive this credit, which, so if you receive the check, there's no taxes due. It's not like, do I put this on my tax return? Do I have to pay taxes on it? It is a tax credit that they just advanced you, right? So they gave you the $1,200 or $2,400 or how many kids that you had, right? Whatever dollar figure that you received, no, that's not taxable income, right? It's not dividend income. It's a tax credit that they fronted us. For those of you that did not receive that stimulus check, you still might be able to receive that tax credit as long as your 2020 return is under these thresholds: 75 single, $150,000, 150,000 married. So if you fall underneath these thresholds, you will get these credits. So it's very interesting that, no, this is not income, this is a tax credit. And for those that didn't qualify before, may qualify still, just because, let's say, if your income was down prior to the previous 2 years.
Yeah, and a couple more things on that. So there was a second stimulus. This was in December. So this was $600 per individual, $1,200 per couple. Same rules, essentially. So it will also then be trued up, if you will, on your 2020 return. So there's a new line on the return. It's the Recovery Rebate Credit. It's on line 30. So that's what you have to deal with to be able to show that you got the credit or you didn't get enough credit. There is a worksheet in the instructions. It's 21 lines. It's a little complicated, but you have to work through it. I think for many of you probably use tax software. It's going to be a lot simpler than trying to work through the instructions.
Yeah, absolutely. With pencil, writing that 1040 out. Two other things real quick is that the required minimum distributions were waived. So if you took your RMD, you didn't necessarily have to. You'll still have to pay the tax. But if you don't see your RMD, you're like, oh my gosh, I didn't take that required distribution. Am I going to get penalized? No, it was waived. And then the CRDs, the coronavirus related distribution. The IRS gave us, or this CARES Act gave the ability to pull money from a retirement account and not necessarily pay any penalties if you're under 59 and a half, and also had some unique features in it where you could pay it back over 3 years or pay the tax over 3 years. So if you did do a CRD this year, there could be some interesting tax complications on your return, which we'll get to when we come back from this quick break. Hey, go to our website, Your Money or Wealth, click on that special offer. It's our 2021 Tax Planning Guide 2021. Right, so we can look forward, but also make sure that you don't screw up your 2020 return. YourMoneyOrWealth.com. Click on that special offer. We'll be back in just a second. You're watching Your Money or Wealth. Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson and Alan Clopine hanging out here talking about tax filing. Right, get your shoebox out. Right, start collecting your documents. Because you got to file your taxes. Stick around. We got Jake Greenberg joining us. He's a certified financial planner, managing director at Pure Financial Advisors. We're going to talk about common mistakes that people make when filing their taxes. But before we get there, let's go to the true-false question.
If I pay back my coronavirus-related distribution by 2022, I can avoid paying any income taxes. Joe, true or false?
I have no idea. Well, I don't know. What if so someone took a CRD and they paid it back? Is that the question? They don't have to pay any taxes?
Yeah, that's right.
Well, yeah, if they pay it back, they don't have to pay any taxes. But when did they pay it back?
Yeah, well, it didn't say. So it's true, but there's a caveat,
Got
right?
it.
So it's true, if you pay your coronavirus distribution back by 2022, you don't pay any taxes. However, you need to pay taxes 1/3 in 2020, 1/3 in 2021, and in 2022, no taxes, then you file amended return to get those other taxes back. So it's a little sloppy, but that is a true statement.
So if I paid an extra $5,000 in tax because of the CRD in 2020, 2021, and then I pay everything back in 2022, then I get that $10,000 refund.
You do, without interest, of course.
Without interest. Yeah. Got it. Okay. Very good. Hey, two other quick things before we get Jake Greenberg in here. We had the Secure Act was signed just a few years ago, and there had some significant changes in regards to retirement accounts. Was probably the biggest one, the elimination of the stretch IRA. But the other two that were pretty cool is that they extended the required minimum distributions from age 70 and a half to age 72. And then now there's no age limit, Big Al, so you can continue to contribute to your IRA
as long as I'm working.
As long as you want.
Or as long as Annie's working. Huh?
Yes,
yeah.
You got it.
Yeah, right. So one more thing on the stretch IRA. So this is where when you inherit an IRA and you're not the spouse, so non-spousal IRA, you used to be able to stretch that IRA over your whole lifetime. In other words, you could take little chunks out over your lifetime. They got rid of that with the Secure Act, but there's a couple exceptions. And the exceptions, first one I already mentioned, so it doesn't apply to spouses. But if you're disabled or chronically ill, it doesn't apply. If you're a minor child, it doesn't apply until you reach the age of 18. Then you got to go to the 10-year payout. And then if your beneficiary is within 10 years of the age of the IRA owner, then they can use the old rules. So just be aware of that.
Fairly complicated, Al. A lot of different changes, a lot of different rules, and there's probably a lot more to come. Let's bring Jake Greenberg in to talk about mistakes that people make. Mistakes is that even a word? I don't know.
I don't
There's
think
a lot
so.
of mistakes that happen
that's
when people you get flustered when you talk about taxes because you don't want to pay them. So let's not pay more than we need. Jake Greenberg, welcome to the show, my friend.
Thanks, Joe, and welcome, Jake. Thanks so much for being here.
Of course, nice to be here again.
Let's talk taxes. So, mistakes people make. I think one of the things people do, they get so anxious to file, to get their refund, they file before they receive all their forms.
Yep.
It's not necessarily a good idea.
Yeah, no, especially because those that are wanting to file quickly, they could be missing 1099s that haven't come in yet. Sometimes when you do get a 1099, especially for like a brokerage account, for example, sometimes they'll issue amended 1099s later. And if you're too quick to file and those documents come later, now you're just creating more work for yourself because you're going to likely end up needing to file an amended return.
Yeah, exactly. And those corrected 1099s generally come in all the way through March, mid-March, or sometimes later.
Yeah, they can.
So here's another one. People tend to put the income on the wrong lines, and that's not very good either because of the IRS's matching.
Yeah, so I see a lot, especially people that do their taxes themselves. It's not the most straightforward thing to do. I mean, a lot of times you're maybe getting income that you haven't received before, especially if you've retired and now you've got income coming in from IRA accounts or pensions, and it can get real confusing what line to put that on. Sometimes it's taxable, sometimes it's not taxable. So depending on where you're putting that income, you could either end up paying too much tax or maybe not getting credits back that you should or the right deductions, and again, ultimately having to make you file an amended return. And the IRS does not have a habit of letting you know if you paid too much and you filed your taxes wrong. They're not going to let you know that you should have gotten a refund in most cases. So
they're all over you.
If you paid too little, they're going to let you know. If you paid too much, probably going to say much.
Here's another one. So you're an independent contractor. You got a few 1099s, but not all of your income was received on 1099s. And the tendency is to only report income on 1099s. And that's not necessarily correct either.
Yeah, no, technically you're supposed to report all of the income that you have. So if you got a 1099 for it or not, you still need to report it. And for a lot of business owners, if they're dealing with vendors that maybe aren't big companies, there's maybe sole proprietors, it's a good chance that they're probably not going to send you a 1099 at the end of the year, but you still need to be tracking all of the income and expenses and all of those other things that of course, you need to be reporting on your return.
Yeah, and of course the IRS, if they audit you and check and they find unreported income, they sometimes refer that over to the criminal department. So you don't really want to go down that path.
Yes.
Okay, how about this one? The standard deduction a couple years ago was basically doubled. It's a lot higher, so a lot of people just do the standard deduction, but in some cases they're missing out on deductions by not taking a look.
Yeah, so when the standard deduction was doubled, a lot of people, especially if you don't own a house and you're not paying mortgage interest, some people just kind of assumed that, yeah, I probably can't itemize because my other deductions aren't enough to exceed it. However, depending on the year, let's say that you had, higher medical expenses, or maybe you gifted to charity, or whatever the case may be, you still want to fill it out just in case it does go over. Even if it's just a little bit over, you still want to itemize instead of taking the standard, because of course it's going to save you some money.
Yeah, and certain states like California, for example, where we're at, they did not increase the standard deduction, so you're missing out there as well. So what about IRAs? When you do an IRA contribution. In some cases, people miss those contributions, and that's not the best strategy either.
Yeah, so with an IRA, you do have until April 15th to make a contribution. So a lot of times when you are preparing your tax return, you should be in the habit of, even if it's a Roth, including that income, or including the contribution on the return, because those contributions are based on your income. So if you're filing by hand, of course, the software isn't going to tell you if you could or not. But if you're using, some of the more common tax softwares out there, it's going to tell you, hey, you were allowed to make that contribution or you weren't. So also with an IRA account, depending on your income, if you did make a contribution, it's possible that you may get a deduction for it or maybe not. So reporting that correctly is going to be important.
Yeah, and speaking of tax software, for people that file their returns by hand, math errors is one of the most common things, and so I tell people, don't do it. There's good tax software out there, there's good professionals, and it just goes a lot better. The math errors is the most common mistake for people that file by hand.
Yeah, believe it or not, I actually still have a few clients that do that. And another way that some of my clients will do it is they're not even using tax software, they're just downloading the PDF and then typing everything in.
Sure.
But you just, in many cases, don't know what you don't know, and sometimes you could be, again, causing yourself mistakes that is going to cause you trouble later.
Well, thank you so much, Jake. That was great information.
Sure.
Great stuff, guys. Hey, go to our website, yourmoneyyourwealth.com. Click on that tax planning guide for 2021. Don't make the mistakes that we just talked about. Learn more. Go to yourmoneyyourwealth.com. Click on our special offer this week. It's our tax planning guide. We got to take a break. We'll be right back. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joey Anderson, Alan Clopine. We're talking about tax filing tips. It is tax time already. Can you believe it? Before we finish the show, go to yourmoneyyourwealth.com. Click on that special offer. We got the 2021 tax planning guide. Help you out there. 2021 tax planning guide. Go to yourmoneyyourwealth.com. Click on that special offer. Let's see how you did on the true-false question.
If I inherited a non-spousal IRA prior to December 31st of 2019, I can still use the old stretch IRA provisions for the rest of my life. True or false, Joe?
True, very true. Yeah, we talked about the Secure Act that changed all of that. So if you did inherit a retirement account, you can still stretch the tax out over your life expectancy. Some questions come about of, now that the rule changed, now do I have to comply with the 10-year? No, you can continue to drain the overall account as quickly as you want, but you can at least stretch it out over your lifetime. So that's the good thing.
Yeah, and I think, Joe, the interesting thing is a lot of IRAs that are inherited are small. And so we find that a lot of people just go ahead and distribute anyway, so it doesn't really matter. But for those IRAs that's larger, if you got it before December 31st of 2019, you still can stretch it over your lifetime. So why don't we talk about a few things you can still do for 2020. So one right here is you can still do an IRA contribution, regular IRA contribution, Roth IRA contribution by April 15th of 2021 for your 2020 tax return. You can do $6,000 or $7,000, extra $1,000 if you're over 50. And if you want to do the Roth, there are some income limitations. If you're single, once you hit $124,000, it starts phasing out. If you're married, once you hit $196,000, it starts phasing out. And if you're over those upper limits, then you can no longer do a Roth IRA. So just be aware of that. And Joe, I think there's a few more things people can do.
Yeah, I would say about 95% of all the tax planning needs to be done in the calendar year. So your focus really should be on 2021, because there is a ton of things that you should be looking at each and every month to make sure that you reduce the taxes, because it always never fails. It's April, you're doing your taxes and you're like, oh my gosh, look at how much money I owe to the IRS. I should have done some tax planning. Well, it's too late. But here's some really good things that you can do that will save you maybe $5.
Better than nothing, right?
Better than nothing.
So let's start with that. Get organized, right? Take out that shoebox. Look at those receipts. Go through your checkbook. Go through your online statements, whatever you have. Go through your credit card bills. You'll probably find some stuff that may be deductible, right? So that can still help you for 2020, because a lot of times people wait till April 15th. They don't have time to look through their records, and they end up missing deductions. Another one is if you're self-employed, you can still fund a SEP IRA, Simplified Employer Pension Plan. That's typically 25% of your bottom line profit on your business. So that can be done by April 15th or even October 15th if you extend your tax return. $300 charitable deduction, Joe, that's a new above the line. So even if you do a standard deduction, you now can deduct $300 in addition to the standard deduction. You can save $5 on your return.
That's giant. It's a giant one.
Another would be you can fund your HSA account, health savings account. So that's if you have a health savings qualified insurance plan, health insurance plan. And then finally, there's lots of credits. Make sure you don't forget them. A common one is child care credit, or child credits, solar credits, electric car credits. There's all kinds of stuff. Make sure you're taking advantage of all these, because these put more dollars in your pocket.
Yep. Well, I guess the big thing is get organized, right?
Yeah.
Just start taking a look at stuff to see that you don't miss anything, and then just rewatch the show over and over and over again, and then you'll never watch it again. Let's go to Ask the Experts.
This is from Walter, Rancho Santa Fe. I've heard that the estate tax exemption may be reduced in the near future. Are there any strategies to reduce future estate taxes that my kids would have to pay when I'm gone? Walter, there's a bunch of things you can do. Probably the easiest thing is right now it's $11.5 million exemption per person if you pass away. So that means if your total assets, including your home, are less than $11.5 million, they go to the next generation tax-free. But if they're above that, then there's a estate tax of 40% of anything above that. There's talk right now of reducing that $11.5 million to $5.5 million or even $3.5 million. So one of the strategies people are thinking about right now is if you're over those amounts, gifting to the kids or your beneficiaries early while you're still living, while we still have that $11.5 million exemption. You use it up, right? But you can use it while you're living. That's called gift tax. If the IRS reduces the exemption, they're not going to claw back that other gift. And Joe, of course, there's lots and lots of other estate planning strategies.
Walter, did you get all that? Did you get that? He's like, I got to get a hold of Big Al.
You're going to have to watch that a couple times to pick it up.
Let's go to Sandy.
Okay, Sandy from Oceanside. What is the deadline for giving to my children the maximum gift allowed for 2020? Is it the same as the tax filing deadline? What do you think, Joe?
If I understand the question, Sandy, you are trying to give to your children, and you want to give the annual exclusion amount of, let's call it, what is it, 13,000?
15,000. Yep.
All right, so she's giving 15,000 to her children each year. And so she's looking at, can I wait until the tax filing deadline to give that gift, or do I have to file it now? Or maybe it's a larger gift. The gifts need to be done in the calendar year, Sandy. So if you do a gift this year and you want to count it for your annual exclusion of last year, sorry, it's too late. So like I said before, most of the tax planning strategies, if you're looking at gifting, estate planning, just saving money on ordinary income tax to capital gains tax to all the other taxes in between, you want to make sure that you get it done in the calendar year. That's why we come up with the tax planning guide. Go to our website, yourmoneyyourwealth.com, and click on that tax planning guide. It's our gift to you, our Your Money or Wealth viewer. All right, so what the heck did we learn today? Well, first of all, you got to look at the deadlines. Make sure that you meet the deadlines, file your taxes on time. Be aware of the 2020 changes. There's some nuances that you want to make sure that you're aware of. Avoid the common mistakes that most people make. Just simple mistakes, that's an extra couple bucks out of your pocket. And then also look at last minute strategies. There's always potentially something that you might want to look at. For Big Al Clopine, I'm Joe Anderson. That's another episode of Your Money or Wealth.